Hello, friends. Today we are diving into Intelligent Investor by Benjamin Graham. What if I told you that every single one of these moments of panic is not a threat, but an opportunity? That the secret to lasting wealth isn't found in the frenzy, but in a quiet discipline almost anyone can learn? For over 70 years, one book has been the bedrock for people like Warren Buffett, who called it by far the best book on investing ever written. It's not a get-rich-quick scheme. It's a philosophy, a way of thinking that separates the gamblers from the true investors. Welcome. We're going to transform how you see the market, and more importantly, how you see yourself. Chapter 1. Mr. Market, your manic depressive partner. Let me introduce you to your new business partner. His name is Mr. Market. He's enthusiastic, has unlimited money, and shows up at your door every single day, rain or shine, to offer you a price for your share of the business. Some days he's euphoric. The sun is shining. The future is limitless. On those days, he offers you a sky-high price for your shares. Other days, he's utterly despondent. The world is ending. Nothing will ever recover. On those days, he offers to sell you his shares for a pittance. Here's the crucial lesson. You are never obligated to accept his offer. His emotions are not your commands. His price is not your value. The intelligent investor understands that Mr. Market is there to serve you, not to guide you. When he's manic and prices are soaring, you have the opportunity to sell to him. When he's depressed and prices are in the gutter, you have the opportunity to buy from him. Your power lies in your ability to say no thank you and to wait for the offer that makes sense for you. Most people fail because they do the opposite. They buy when Mr. Market is euphoric and everyone is getting rich, and they sell when he's depressed and fear is everywhere. They let a manic depressive set their emotional agenda. Don't be most people. Chapter 2. The Unbreakable Wall. Investment versus Speculation. Before you spend a single dollar, you must build a wall in your mind. On one side of this wall is investment. On the other side is speculation. They are not the same. They will never be the same. Investment, as Graham defines it, is an operation that, upon thorough analysis, promises safety of principal and a satisfactory return. Not a spectacular return, a satisfactory one. It is based on the actual, measurable value of a business. Speculation is everything else. It's betting on price movements. It's chasing the next hot trend. It's buying something because you hope someone else will pay more for it tomorrow. The greater fool theory. Let me tell you a story. It's the late 1990s, the dot-com bubble. Companies with no profits, sometimes no revenue, are going public and seeing their stock prices double, triple in a day. The speculation is rampant. What would the intelligent investor do? They would look at these companies, unable to see any underlying business value, and would say, "This is not for me." They would stay behind their wall. They would be called boring, old-fashioned, missing out. And then the year 2000 arrives. The bubble bursts. The speculators are wiped out. The investors who never bought in are not only unscathed, they have capital preserved, ready to buy real businesses at real prices when Mr. Market is finally depressed. The lesson is brutal but simple. Know which side of the wall you are on. There's nothing wrong with speculation if you acknowledge it for what it is, and only risk money you are prepared to lose entirely. But never, ever confuse it for investment. Chapter 3. Your two personas, the defensive versus the enterprising investor. Now, who are you in this world? Graham gives us two archetypes. You must choose one, consciously. First, the defensive investor. This is for the vast majority of us, the individual who does not have the time, desire, or perhaps the skill to constantly analyze businesses. Your primary goal is to avoid catastrophic mistakes. Your path is one of simplicity and consistency. Your strategy? A permanent, automated portfolio of high-quality bonds and low-cost, broad-market index funds. You are the tortoise. You ignore the hares. You make regular contributions in good times and bad, and you let the miracle of compounding work over decades. You will sleep soundly. Second, the enterprising investor. This is not a part-time role. This is a serious pursuit requiring significant time, discipline, and emotional fortitude. This investor actively seeks undervalued opportunities, what Graham called cigar butts that might have one good puff left in them. They perform deep, fundamental analysis, looking for a margin of safety. This path can offer higher returns, but it carries greater risk of error and requires immense work. Most people who try to be enterprising are, in truth, just speculators in disguise. Be honest with yourself. There is profound dignity and extraordinary results in being a committed defensive investor. It is the quiet, sure path to wealth. Chapter 4. The Magic Margin of Safety. This is the single most important concept in all of investing. It is the engineer's mindset. The margin of safety is the difference between the price you pay and the intrinsic value you estimate. You never drive a 1,000-ton truck over a bridge built to hold 1,001 tons. That's reckless. You build a bridge to hold 10,000 tons. That extra capacity is your buffer against error, miscalculation, bad luck, or a sudden storm. In investing, you only buy a business at a price so low that even if your analysis is somewhat optimistic, or if the future is slightly worse than you expect, you are still likely to avoid a permanent loss of capital. How do you find it? You look for companies trading for less than their net current assets. You look for strong businesses temporarily out of favor. Perhaps there's a scandal, a missed earnings report, a sector-wide panic. Mr. Market is offering them at a fire sale price. You are not predicting the future. You are buying $1 of value for 50 cents. That 50-cent discount is your margin of safety. It is your protection against the unknown. It turns uncertainty from a threat into an ally. Chapter 5. The Ghost in the Machine. Conquering Yourself. The greatest obstacle you will ever face in investing does not live on Wall Street. It lives in your mind. Benjamin Graham understood that our own psychology is our own worst enemy. We are hardwired for the herd. We feel greed when we see others profiting. We feel terror when we see prices falling. Graham called these the twin demons, fear and greed. They are the puppeteers of Mr. Market, and they will try to be your puppeteer too. The intelligent investor develops a set of unwavering principles, like the ones we're discussing, and follows them as a formula. This is your armor. When the market is euphoric in 2021 and every headline screams about crypto and meme stocks, your formula says, "This is speculation. I stay the course with my index funds." When the market crashes in 2022 and your portfolio is down 20%, your formula says, "Mr. Market is depressed. This is when I continue my regular investments, buying more shares for less money." You are not a machine. You will feel the fear. You will feel the greed. The goal is not to eliminate them, but to recognize them and to let your principles, not your impulses, make the decision. Your formula is your anchor in the storm.
Chapter 6. The Peril of Prediction. Why Nobody Knows the Future. Listen to that noise. That is the sound of the forecasting industry. An entire ecosystem built on a lie. The lie that anyone can consistently predict short-term market movements. Graham was ruthless on this point. He said, the investor with a portfolio of sound stocks should expect their prices to fluctuate and should neither be concerned by sizable declines nor become excited by sizable advances. You are not in the business of predicting what the market will do next month. You are in the business of owning pieces of profitable companies over the long term. Think of it like owning an apartment building. You don't get a daily appraisal of its value. You don't panic sell it because one day a neighbor says it's worth less. You care about the quality of the tenants, the solidity of the structure, the reliability of the rental income. The stock market is the same. The daily quote is just Mr. Market's often insane opinion. Ignore the opinion. Focus on the underlying business. Chapter 7. The Modern Intelligent Investor. Your Action Plan. So what does this look like today in your life? Let's build your plan. Step 1. The defensive path. For 95% of viewers. 1. Open a low-cost brokerage account. 2. Set up an automatic monthly transfer. 3. Buy one fund, a total stock market index fund like VTI or FSKAX, or an S&P 500 index fund like VOO or FXAIX. This gives you a tiny piece of hundreds of America's largest companies in one transaction. 4. If you want bonds for stability, add a total bond market index fund. A simple starting rule, your age as a percentage in bonds. 30 years old, 30% bonds, 70% stocks. 5. Automate it. Forget it. Log in once a year to rebalance if needed. That's it. You are now outperforming most professionals over time because of low fees and zero behavioral error. Step 2. The enterprising path. A warning and a method. If you must walk this path, your process is sacred. 1. Analysis, not tip finding. You study annual reports, 10Ks, not message boards. 2. The quantitative screen. Look for companies with a long history of profits, low debt, and a current price that is low relative to their past earnings and asset value. 3. The qualitative check. Is this a business you understand? Does it have a durable competitive advantage, a moat? 4. The margin of safety calculation. Is it priced so low that you are protected from being wrong? If not, walk away. 5. Diversify. Never bet heavily on one idea. Build a portfolio of 10 to 30 such undervalued securities. The final lesson of the intelligent investor is not about money. It's about time. It's about character. True investing is profoundly boring. It is the rejection of excitement. It is the cultivation of patience in a world addicted to speed. Your greatest asset is not your capital. It is your ability to sit still while the world frantically rushes around you. You will be tested. You will watch friends brag about overnight gains. You will feel the ache of doubt during a bear market. In those moments, remember, you are not playing their game. You are an investor. You have a partner, Mr. Market, who is mentally unstable. You have a wall between investment and speculation. You have a margin of safety. You have a formula. You are an island of discipline in a sea of chaos. This philosophy is a shield against poverty, but more than that, it is a path to a peaceful mind. It is the understanding that wealth is not a sprint, but a gentle, relentless walk in a chosen direction. Your journey starts now, not with a trade, but with a decision. The decision to be intelligent, to be disciplined, to be patient. If you believe in building lasting wealth on a foundation of wisdom rather than hype, then you belong here. Subscribe to this channel. We are a community dedicated to this calm, disciplined approach. We dive deep into the classics, like Graham's work, and apply their timeless principles to the modern world. Every week, we build the mindset that leads to freedom. In the description below, I've left a link to a free PDF checklist summarizing the 7 core principles we discussed today, your cheat sheet to becoming an intelligent investor. Thank you for your time. Thank you for choosing the path of intelligence. Now, go out there and build your fortress.